Are you being excluded? This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Matt Charne, your host for this week's accounting and auditing episode. I'm an audit director at Clifton Larson Allen. Joining me today, as always, is Marissa Flood, Assurance Senior at CLA. Welcome back, Marissa.
Happy to be here.
Yeah, great to have you. This episode qualifies for a NJCPA credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statements expressed herein are our own and not necessarily those of the NJCPA or of CLA. Okay, so we started with a bit of an exclusion today.
Which first, by the way, way to really pick that as the opener, because now we're going to get a call from Brad Muniz saying, yeah, we did get excluded from the podcast.
I can feel my phone buzzing already.
Yeah.
Reason I went with that, though, is because we have a new ASU today, which is ASU 2025-07, which I can't believe I remember all these different codes. But
you're better than me.
yeah, the specific change today is for derivative accounting, which is everybody's favorite and super complicated, awesome topic that always throws me for a loop.
It's usually pretty daunting when I see that there is a derivative involved in one of my audits.
Mm-hmm.
So
absolutely, it's one of those like evil words that you try to stay away from, because even if you say it and a reviewer or inspector hears you, it triggers all sorts of other questions. That being said, this update I think might give some people some comfort, because we're excluding a bunch of stuff from the new derivative rules at this point. So we'll get to the ins and outs of that, but just to kind of start with the basics, the definition of a derivative, it basically means is something variable, right? So if you had some kind of warrant or some kind of debt agreement that had a convertible bond, maybe it converts into a warrant, you would typically need to account for that as a derivative. Not to get anybody's hopes up, those rules are not changing today, but other things connected to that will. And the reason we account for those as derivatives is because you have to value that bond or that piece of equity, that warrant that's attached to your agreement in order for you to get your financing and your debt. And you don't really know what the value of that is going to be. And so you create this set of rules called derivative accounting rules, which I forget the specific ASC, but are being updated through this new ASU, and would say you have to look at that piece of, I guess, financial instrument and come up with a value for it.
Yeah.
It's a very long-winded way to say we're not sure what this value is, so we're going to basically estimate it and fluctuate it each reporting period.
Which is complicated, timely,
costly,
a little bit costly, yeah.
Confusing, to say the least. That being said, this ASU, I know it's related to derivatives and can get a little complicated. I will admit I used a little bit of a crutch on my own end and actually threw this into an AI tool and had it summarized for me as if I was a first grader. And so,
very smart. Just
to read off some of those changes for you guys to see if it helps kind of make things a little simpler here, there are two kind of provisions that the standard is creating here. The first one is to kind of say, we're going to make things simpler. The new rule says if you make a deal where the results depend on how well you do something, such as, and this is where the first grader example comes in, if you're selling a lot of lemonade or if you win a science fair, you don't always have to use your now super complicated math rules, aka derivative accounting, in order to account for that. You can just do it logically. And so in the past, that was not the case, right?
Yep.
If you had some kind of contingent contract where you were dependent on maybe a sustainability requirement, a litigation outcome. We had a few examples written down here. Some kind of regulatory approval, an earnings or a sales target. Those come up quite often. You would have to figure out what is the value of this contract and all these rules, because I'm not sure.
Yeah.
And if you're not sure, what do you put down as the journal entry? Well, the answer is a derivative, and you would have to value your derivative. This provision of this new rule, which now is being explained to me as a first grader, which is the only way I could understand it, is saying all of these things are now excluded from that rule.
Yeah, and to make it make sense in my head, I feel like this has taken what previously was the more complicated areas to kind of assess and come up with those estimates, and has now taken that out and made it easier. That's how I'm feeling about this.
Right.
And I'm feeling good about it.
Okay.
just wanted to put that out there.
Yeah. You might say they're easier because some of the other tools that are still
Yes.
included in derivatives.
We'll get into that still, but
you would typically need a valuation report
Yes,
for.
yes.
I say we get into it now.
Yeah, let's
Because
do
I
it.
wanted to make that distinction. So the items that are being excluded, the overarching kind of umbrella that can capture all of these items is if you yourself, aka being the company or your client, are responsible for creating those conditions. Any other kind of condition, if it's a market condition, a commodity, an industry, something like that, if it's the price of gold, if it's tied to equity, if it's tied to some kind of bond or security, in bond in this case I mean a government bond, it's an outside force that your company really can't influence,
Okay.
that is still a derivative.
Okay. So no influence and no control.
Those are not excluded. They still get to hang out and be in the cool derivative accounting club if
Lucky
that's
us.
if that's a thing and people want to be in that club. So these other items that are dependent on your company's performance, again, the litigation, sustainability, you're responsible for making sure that your energy outputs are a certain level. If you get a certain outcome in some kind of legal case, that may not be 100% up to your business, but the facts and circumstances are contained, right? There's no outside market that can really change what's happening in your case. And hopefully you hired a good lawyer to defend you and make sure that you get the outcome that you need.
Which, really, that's still, you hire a good lawyer, that's still something you can control.
Correct.
So,
Yes, perfect
would
example.
argue
Thank you. Yeah. And then, of course, the most obvious one here, the earnings and the sales targets, which I know these used to be really hard to estimate because you're basically taking a projection or a forecast on the pro forma financial statements and saying, well, I think I'm going to hit this sales metric that if I hit it allows me to borrow more money from my bank.
yeah.
And therefore my loan is now worth X amount more because I can borrow on it, and so on and so forth. That may not be the case if you haven't drawn down on it yet. It might just be a disclosure, but for the most part, all of those things, no longer derivatives. We're just going to account for it logically. Did you hit it yet, or did you not? When you hit it, make the journal entry. If you're never going to hit it, don't make a journal entry. Much easier.
Great. And I don't know if we've hit on it yet, but how are we accounting for it now?
Accounted for now as a derivative, which
Or-
has to be valued, has to be estimated,
Yep.
has to go through the models. Complicated. If we needed to do a much more in-depth example, I would need another 45-minute podcast.
Which I'm sure everyone would really love to listen to us drone on for 45 minutes about derivatives.
Certainly. Maybe another day. So let's go back to our first grade kind of examples here. So we got through the first provision, which is making things simpler. Then there was the next one, which said, well, what if I'm getting paid with shares instead of money? And the example that it kind of generated for me says, well, sometimes instead of getting paid with dollars, a company gets paid with pieces of another company, like getting the golden ticket or a share in your lemonade stand instead of getting cash. The new rule says, wait until you've finished your job before you count those shares as yours. So again, we have another example, more so on the sales side, which is why I kind of separate this from the other provisions, which are typically financing and obtaining debt and equity and things like that. This is saying, previously, the accounting for any kind of sales contract with a customer where they say, I just don't have the cash to pay you, but I can give you 15% of my company, and if you help me finish this sale, maybe I'll start to grow and I'll have the resources I need. And from there, you can enact your transaction as normal and take your shares and be on your merry way, almost like non-cash barter. So under the old rules, that's considered a derivative now. You've been promised the shares. You don't really know how much they're worth. Maybe they have a valuation, maybe they don't. If they do, maybe it's outdated. So there's a lot of question marks that kind of go up in the air, which is why we put that on the books and say this is variable. And we're not 100% sure what the value is, so we're going to call it a derivative and update it as we go on. ASU 2020-507 says, no, we're not going to do that. All of those steps and exercises just to get to an answer at the end of the day when you actually obtain the shares and complete that contract and finish that sale, is saying, the update is saying, we're just going to make the journal entry when we have the shares in hand. And at that point, there's a very clean cutoff, and we know exactly what we got and what it's supposed to be valued at that date. and that's what we're going to book.
Simplified. I like it.
A lot easier. So yeah, we'll be keeping our eye on this. I think there's a lot to consider. There are a lot of examples that we probably didn't even get to.
Definitely didn't get to. I think that we could have talked about this, like you said, for another 45 minutes.
Oh yeah,
So,
oh yeah. Well, let us know if that's another follow-up podcast you guys would like to see.
yeah. I'm looking forward to this one. I feel like it'll make things a lot more simplified.
Right, right. This will be a good topic to revisit soon. In closing, though, here are some upcoming events you might be interested in. On November 11th, the Hudson chapter is holding a 4-credit ANA update in Secaucus. If your firm hasn't implemented the AICPA's new quality management standards, attend a November 14th webinar to learn more, and learn how to avoid deficiencies in your peer review at a November 17th webinar. Get information about these events and more at njcpa.org/events. And of course, be sure to join the Society's Auditing and Accounting Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.